topic this morning is regarding sector trends and outlook for 2019. Where do we go from here? But for those of you that aren't aware, last year there was a survey that was done that was similar to what we're going to be discussing, which had to do with the challenges in 2017 and what the outlook was going to be in 2018. So we're going to kind of weave that in every once in a while as our panelists discuss what they see in the future. So I have the honor of moderating a distinguished group of panelists, and as you'll see when they speak and introduce themselves, they represent a diverse group of focuses in our industry. So this will be very informative. So I'm going to lead it off, and I'll start with Richie Prestegard from High Road Capital. So introduce yourself and tell us about the firm, and this way people are educated as to what you're looking for, and you'll get 16 deals out of this forum.
All right, Corey, thanks. My name is Rich Prestegard. I'm a partner. I lead our business development efforts at High Road Capital Partners, which is located just down the road on 6th Avenue. We've been around since 2007, focused on smaller middle market equity buyouts. We are opportunistic in terms of industry. We're focused a little more on size and quality of company and position the businesses have in their usually relatively small market niches, and trying to find ways to help them expand the niche and become a bigger and qualitatively better company over the course of our ownership. I think I said we've been around since 2007. We're focused on US and Canada and control-only investments. That's our quick recap.
And next to Rich is Jeff Johnson. He's a managing director at Blackford Capital. So, Jeff.
Good morning, everyone. I'm Jeff Johnson. I'm a partner at Blackford Capital. We are a West Michigan-based lower middle market private equity firm. We've been around for about 2 decades. We have 13 portfolio companies today. We focus principally on the Great Lakes region, or the upper Midwest part of the United States. Our bread and butter is industrial companies and manufacturing, although we will do a little bit of business services and distribution as well. Focused on companies typically from 3 to 15 million of EBITDA. We've carved out a bit of a niche in working with families in terms of some of their transition plans, and most of the investments that we've made over the past number of years have been family-owned businesses where we're the first institutional capital that comes in the door, and we work with the founder-operator on growing and expanding the business plan.
And next to Jeff is Harvey Fine. He's the managing partner of Maris Globe Capital. And Harvey?
I am Harvey Fine. For 15 years, I've been a China-focused cross-border investor, which means I'm investing in China and non-Chinese companies that we think have a China market potential. For most of the time, it's been leading Fosun Group's investment efforts. Fosun is a Chinese conglomerate that invests globally, and then more recently with Maris Global Capital, which is a private equity firm on behalf of multifamily offices. And our focus is now on investing in cash flow producing companies that are leaders in their niches, where we think there's an opportunity not only for growth in China, but also in some sort of digital transformation, which we think we can help with.
And next to Harvey is Jim Lockhart III. He's the vice chair at W.L. Ross & Company. So go ahead.
Yes, well, W.L. Ross, as you know, has historically been a distressed investor, Wilbur's old firm, and it's owned by Invesco. At this point, we're very active, moving more to sort of middle market LBOs, have a couple of China funds and some real estate funds, and I've spent some time in Washington. I'm a senior fellow at the Bipartisan Policy Center.
And myself, I'm a partner and the managing director at UHY. UHY has 18 offices in the United States, and approximately we're in 98 countries globally. So we cross over as a global firm. We're an accounting firm, but more so we are a different type of accounting firm that no one knows about. And about 800 professionals. We have a lot of advisory services that are unique for a firm our size, cybersecurity, processes and control environment studies with Six Sigma and industrial engineers. And of course, with the depth of our firm being as large as it is, you would expect us to handle very complex tax situations internationally and national, and especially, recently with everything that's going on with tax reform and structuring, and especially on deals, some of the challenges with doing buy-side and sell-side representation on deals. And obviously, we do audits and quality of earnings, but we really have a large depth and are very competitive. So let me go to my first question for our panelists. What has been your experiences in 2018 in terms of buying and or selling in this market? Obviously, a broad stroke question. So go ahead, Richie.
Okay, I go first.
Yeah.
Well, what have we seen? It depends on whether you're a buyer or a seller. It's a pretty tough buyer market. It's a very good seller market. It's good to be a seller. It's probably good to be a sell-side investment banker, I'd say. It's just, since I've been at High Road since 2007, this is the most competitive I've seen our environment. That's driven by a lot of different things. Everybody's getting more efficient in the market, on both sides. There's just more people on both sides as well. The economy's going well. I think sellers are finally crawling out of the cracks. People have held on to their businesses for a long time and waiting to get some momentum in their performance. I think that there's plenty of opportunities out there. A lot of times it comes down to where you're willing to pay the price.
All right, Jeff?
I mean, from our perspective, operating at the lower end of the middle market, we've never seen a more competitive marketplace. We've seen a number of new entrants, some family offices that have set up sophisticated direct investment arms. I think the genesis of the independent sponsor has really taken off within our segment of the marketplace. And then in addition, we see firms that have traditionally operated more in the traditional middle market that have come downstream. And I think in part that's a reaction to the multiples that we're seeing at the larger company end, and they're coming downstream. And that certainly put a lot of pressure on our ability to close transactions. We're having a more difficult time putting in unique structures around earnouts and such, just due to the competitive nature. And without question, we're seeing multiples for smaller companies that we've never seen before.
Yeah, I'd agree with that. As a buyer, unfortunately, it does feel like a seller's market. And it's a couple of things. One is certainly the economy's improving, so we see that the companies are performing better, but it's more of a recent uptick as well, which presents challenges for valuation. The other part of it seems like there's a availability of capital, both from the equity side and on the debt side. And because of the equity dry powder and the debt market still being pretty robust, companies are expecting higher prices, and there's more competition for these deals.
And Jim?
Yeah, well, I ran the financial services group at WLR, which has obviously been the distress for the last 10 years since the global financial crisis. And we probably had well over a dozen companies. We only have a couple left. We've been selling to strategics given the valuations, but also IPO'd the last of our 5 banks in the U.S. this year. And on the buy side, I agree with everybody. It's extremely difficult at this point to find things at a reasonable value because we are a value investor.
So with all this competition, how are you finding the quality of the deals that are presented to you? Are they meeting your expectations? And what have been the challenges of closing these deals? Jeff, you want to go?
Well, I mean, challenging. It has certainly been challenging. I think the number of qualified buyers within any process is much larger than we've seen in the past. I feel like there's a much broader set of representation, where historically we were oftentimes able to develop a proprietary relationship with a family or a potential seller. Those opportunities still exist today, but they're very, very difficult to find. And it's a very, very competitive marketplace.
And Harvey, what are you seeing? Because when you're doing deals, is there any component of leverage in your deals?
There is, but we try to be pretty modest about it. So as a result of that, we're not going to do 5 or 6 times EBITDA, which means we can't participate in traditional auctions. It's putting a premium for us finding proprietary deals, which we're happy to do anyway. We feel like that's a better way to do it, or limited auctions. But even then, there's been a challenge in closing deals because the seller's expectations have changed, given what they see in the marketplace. So we're trying to be creative on structuring earnouts and things like that, which is a little bit challenging because, as I mentioned, some of these businesses have been doing pretty well, but in the past 2 years, they've done extremely well. So you're sort of paying off of a recent trend that you're not sure is that sustainable, and you're trying to structure around that, but the seller is expecting is if you're paying off of the most recent year, which has been their best year in 5 years.
Right. And then you got the country club.
Right.
What they hear from the country club.
I'd agree with all of that. The sellers are better educated. They have the country club effect. I think that's a real thing, actually. Your buddy at the club just sold his business for 10 times. Therefore, your business is worth 11, right?
Right.
That is a real thing. And just to put a little more, I guess, color around quality and just, participants in the market, from my perspective, looking at my own statistics, deal volume's up this year 4 to 5%. We're at the smaller end of the middle market, so I don't know if that's because we're more efficient or because there's more deals in the market. It's hard to really tell. I don't have enough resources to see every single deal. I probably never will at the $3 to $10 million of EBITDA range. But it does feel like, for the most part, quality's probably been a little bit better. And what we're doing is just being a little bit more selective about the ones we chase. Because if you're looking at a quality deal, the chances are higher. If you're looking at an A-quality deal, to use that kind of way to talk about it, the chances are much higher that you're going to, be at a high single-digit, low double-digit type multiple, almost no matter what industry you're in. In today's market, if it's of that type of quality and it's in an auction process. In addition, and one thing that's driving all that is it's the capital, it's the participants, the efficiency. When I joined High Road, I think there were 30 firms that had dedicated business development people to go find deals. And no one knows what the number is today, but someone at a bank, an intermediary recently told me that in their database, it's somewhere around 400. So in just 10 years, it's grown to 10 times the amount of people actually out there sourcing deals. So that's a lot more people actively looking for businesses to buy. And then on the other side of it, on the sell side, distribution channels have broadened. Bankers have gotten more efficient in how they get their deal flow out into the market, especially at the smaller end of the market where there are things like Axial and Deal Nexus and other online ways to distribute acquisition opportunities. So you're seeing it on both sides, driving the competition.
I guess I would also add that just given the frothiness in the marketplace, there is a question that comes into play as to just the quality of the company. We're seeing a lot of companies that I think traditionally would not have been bankable in other markets, but given the level of activity and just the publicity around transactions, I think every seller out there feels as though he can generate a premium return for his or her business. And as a result, we're having to spend a whole lot more time kind of on the quality of earnings exercise and really, kind of diving in to see if it's legitimate.
Again, sorry to jump in on this point, but even a lower quality B company that is a lower quality B company in most environments today will get a higher multiple than they would historically, and it's higher than what any of us on the panel probably want to pay for it. So you still have to go through this exercise of, are we paying a premium that makes sense for this particular asset that we can justify?
The issue to me is that at buying it at 10 times EBITDA, you're not going to be able to sell it at 10 times EBITDA.
Right.
And so you're going to have to add a lot of value from the operating side, cost reductions, revenue enhancements, whatever, because we're, as you said, frothy market at this point. And actually, I just saw a statistic yesterday that surprised me that said in the third quarter, PE deals were down a third. And so maybe that's starting to happen in the marketplace now. For the year, they're up, but for the third quarter, they were down. And so I think we're seeing a slowing down because of the valuations.
Yeah, I saw the same thing, and it basically referred to that it was, I think 80% was strategic. So I was going to ask you, what's the mix of the deals you've been doing? Because has it been platforms or has it been add-ons? Because to Jim's point, you buy them with these high multiples. Now you're going to, you got to do something to be able to average it down or do whatever you may be doing efficiencies. Well, what's been the percentage of what you've been doing? Anybody want to join?
Buying at such a high premium, as Jim was saying, puts a premium on making sure you're buying a business that's going to grow. And so you're first and foremost looking very closely at the organic growth story. But secondly, we're also, in the process of evaluating a new deal. We're looking pretty closely at what are the target acquisitions that are out there. I don't know if it was the same source that Jim was looking at. I looked at PitchBook sometime over the last couple of days, and I think they referenced that 2/3 of buyouts in the United States were add-ons over the last year or within this year, which is a pretty high number. But for High Road, it's hard to say because we don't do enough deals per year, but roughly 60% of all of our transactions have been add-ons, 40% have been platforms, and this year it's 50-50 so far.
So you've been reflecting the market. So, Harvey, what do you guys do?
Yeah, we're looking at platform companies. There's two in particular that we're looking at. But one of the challenging things, which Rich alluded to, is that so part of the strategy is to do these add-on acquisitions, but the premise is that the add-on acquisitions are going to come in at lower multiples than the platforms, and that's really challenging right now. So we may be willing to accept a little bit of a higher multiple on the platform company, knowing that it's pretty unique. But if we can't get the more attractive multiples on the add-ons, then we're going to have to wait until that comes around, so that the blended rate is more reasonable.
Jim, I have a question for you. Would be, you're really sector driven. So what trends are you seeing in your sector for this year?
Well, in the financial sector, obviously interest rates going up has helped banks. It's really hurt mortgage companies. And I think the hot sector is really fintech, whether it's related to banking, insurance, investments, or whatever. That's where a lot of money is going, both PE and strategic at this point. And in the U.S. and Europe as well, and Asia. So, but it's the buyers at this point seem to be strategic in sort of the the banking sector, the mortgage sector, or whatever. There's less interest in typical PE.
So I'm going to come back to you because you just spoke about competition. So I'm going to take it to everybody else. So talking about competition for deals, you mentioned strategics. For them it's larger firms, independent sponsors. But let's go into that a little deeper because that's part of the problem that's driving up everything. Not the problem, but it's the issue and the challenges. What are your thoughts about that?
Well, with what's happened in the U.S. with the stock market being so high, the strategic valuation so high, certainly the major cut in tax rates has helped a lot of corporations and helped the stock market as well. And so they have a currency that they look at it relatively cheap at this point. And so we're seeing a lot of deals with a combination of stock and cash. And it's really hard to beat it when you just have cash.
Right, and then then you take into the mix, especially in your industry, you take into the mix, the SPACs that have been formed, $1 billion, $450 million SPACs.
Yeah, we did a SPAC and it was successful, and it's pretty easy to raise SPACs at this point. And the economics of a SPAC, if done right, are very good for the sponsor. So
right.
I will continue to see activity in that space.
If anybody doesn't know what a SPAC is, it's a special purpose acquisition corp for public companies. Harvey, competition?
There are two deals that we looked at that both had SPACs and strategics participate. Neither SPAC made it to the end, and in both cases the strategic won out, and they paid a premium that none of the rest of us were willing to pay. So definitely see the competition from the strategics.
So strategics are your biggest competition for you?
In those two sectors, it was the case. In one of those sectors, we're looking at the educational space, and there's not a lot of strategics there, so it's been okay. It's mostly been PE firms. So I guess it depended on the sectors for us.
And Jeff?
I think it is very sector specific. I mean, we've absolutely seen an increased level of activity with strategics. We sold 2 of our portfolio companies earlier this year to strategic investors, and I think they paid outsized multiples. But what we find interesting is that there seems to be a lot of competition even on the sponsor side, and sometimes they're willing to pay more than a strategic, particularly if they find a business that's a little bit more recession resistant and they're trying to build a platform. And I think of the food sector as being one where we've seen some sponsors come in recently, and they're ideally looking for that strong management team and that portfolio, that platform portfolio company to build around, under the theory that they'll, over time through add-on acquisition, lower that multiple. But, they're paying numbers that even strategics, I think, are questioning.
So going down that path, so an independent, call them independent sponsors, but at the same time, would you say that's more prevalent when the team of the sponsor is going to bring value added and they concentrate in that industry, that they can bring efficiencies, or it's just the platform itself?
I think it's for the platform itself. I think that it's difficult to find a strong management team that can really grow around. And there's, you can buy a poor platform company and spend the first 2 or 3 years just building your management team and the systems around it. So if you find a business that has that already and you feel like you can accelerate the activity in terms of add-on acquisitions, I think sponsors are willing to pay those higher multiples for it.
Rich?
Yeah, I'd agree with pretty much everything that's been said. Definitely strategics have been more active in processes that we're involved in, but honestly, in most cases, when we're at the finish line and losing, it's been probably on balance more to private equity firms that have gotten more aggressive. I mean, we're chasing companies that have a certain profile that are attractive to just about every other private equity firm. Lower recession impact, more recurring, those types of things, high margin, so high value add product or service. So, those are things that people are more willing to pay for in any environment, and they're just being especially aggressive about it today. All the private equity firms have the same pressures, the funded private equity firms have the same pressures about needing to deploy capital on schedule. And the other things that we've talked about already that are driving up competitive pressures, including all the capital available by the lenders. So we're looking at businesses that are small enough that typically they're still a little bit too small and under the radar of the larger strategics. So while there is often some competition for them from strategics, it's not typically that frothy. We hope to see more strategics involved when we're exiting.
Harvey, what in 2018, what would you say that you've seen as the hot and cold sectors that have been you've experienced?
All the sectors that we look right now, we're looking at educational space, healthcare, and media. Those are the 3 areas that we've been focusing on this past year, and all 3 of them were pretty hot. And I'm not so sure that they're hot just because those sectors happen to do well versus that the market overall has been doing well. 2 areas that seem to be colder, retail for one, it's been challenged, and then I would say sort of the luxury space, which is another area that we had been looking at. Although, even though the companies in the luxury space have been more challenged, the valuations don't seem to have matched that negative performance. So, from an M&A perspective, it feels like those markets are similarly strong.
And Jim, I know you touched upon it, but what do you? I'll give you a 2-prong, and then I'm going to come back to everybody because what did you see in 18, and what do you think you see in 19 in terms of sectors for the financial industry?
Well, in the financial side, again, fintech has been a big player this year and probably will be next year. I think as interest rates go up, we may start to see some activities in some of the other areas that will be hit negatively by interest rates, like real estate. And some of the banks, depending on how they're funded, could have some issues. Certainly, mortgage companies are going to see a lot of consolidation in that space, I think. There was, now most of the mortgages actually made outside the banking system and then sold to my old friends Fannie and Freddie, our FHA. And so that space, I think we'll see a lot of consolidation in. Overall, we spent a lot of time in Europe. The financial institutions there haven't really recovered. They were too slow. They didn't have a TARP. And, we've successfully invested in Ireland, but some of the other countries still have a ways to go. So I think, putting on our sort of stressed area, there may be some activity there, but it's, to my way of thinking, they still haven't fixed their problems, so we're pretty wary of that.
That's great. So Jeff, 18 and 19?
Well, 18 was particularly strong in food, and I continue to see that trend going forward. I think the same is in healthcare. We don't invest specifically in healthcare, so I'm not as close to that. I'd say that where we're starting to see a little bit of pressure is maybe in some industries that have traditionally had more cyclical swings and kind of deeper troughs. So I think automotive and building products, we're starting to see a little bit of dip in terms of some of the multiples. And yet, if you talk to these companies and their management teams, I mean, the backlogs continue to look really, really strong. So we're not necessarily anticipating a big pullback, but I do think that as multiples have crept up, people are starting to look at that 5 and 6 year time frame in terms of an exit and trying to kind of build a bit of some pricing sensibility into some sort of correction that will probably happen during their ownership cycle.
Rich?
Yeah, again, I agree with pretty much everything that the folks on the panel are saying. From my own database and experience of deal flow that we've seen this year, our hot sectors have been industrials, healthcare, consumer broadly, which does have a lot of the food deals in it, and that's driving a lot of what we're seeing in consumer, we think. And commercial kind of rounds that off, but the first three are really been where we've seen most activities. And I honestly would say I think that's going to continue into 19. So my answer is kind of simple. I don't think we're on the cusp of a drastic change unless there's some unforeseen big impact kind of news event or terrorist attack or something like that. So I think housing even still has a lot of legs and wind behind it. I hope they do because we own a couple of building products companies. So I think that actually 19, absent some unforeseen, I think even with interest rates and everything else that we were talking about here, I think we're still going to see the same sectors kind of be active.
So last year when we did the survey, the hot sectors were tech, healthcare, financial services, energy, transportation and logistics, and consumer goods. So you can see it's kind of continued on in this year, which is unusual. I guess none of you guys are in transportation and logistics, but transportation and logistics, I would think from what I've seen, is going to continue on. So we'll see where that goes. So the next question is that I guess going into 19, and I'm circling back to the other questions after this, but since we're on this trend, going into 19, what do you see as the biggest challenges for your firm in the industry? Continued excess powder, continued high multiples, rising interest rates, politics globally, U.S. potential changes, and tariffs? I said a mouthful.
I think all of the above.
Yes, everything. Yes.
So go
From our
ahead.
standpoint, I think that every one of them is going to be a challenge. Our government affairs people had a conference the other day, and they said the only certainty is uncertainty going forward. And certainly, as you look at Washington at the moment, there's a lot of uncertainty there. The interest rate thing, CFIUS, which is a big issue for China, but the tariffs, where they're going to end up. And certainly looking at Europe and the Middle East and Asia, there's a lot of uncertainty, Brexit, Italy, what's happening there, the whole Middle East, and the China tariff issue. So from our standpoint, that may present some opportunities, and I think it will if we're smart in trying to find, the ones that will be affected by that and the ones that will prosper by that. So we're still hopeful that there'll be some reasonable deal activity next year, and hopefully some of the valuations will come down to more reasonable levels.
I agree with what Jim has said, and for us, the availability of dry powder and high multiples are sort of linked. So from the investment standpoint, that's the challenge. From a portfolio management perspective, the tariffs will potentially be an issue.
Yeah, I would think so. So especially with China. So, Jeff?
I mean, agreed as well. I feel like seller expectations and the multiples, continue to put a real pressure on us in terms of just, do we have a sustainable business model that can carry through, a potential correction based on the leverage that we put on these businesses.
Yeah. And you got to compete to continue to buy businesses today. So the leverage and the multiples we have to pay and all the excess capital that's out there is probably the biggest concern for us as a U.S. and Canada focused firm. We have probably secondary impact from some of the global uncertainty and concerns that some folks have, but obviously those impact us as well.
So, you touched upon it. With interest rates rising, have the debt ratios changed on your purchases? Has the availability of sources of debt changed? Who wants to jump on that one?
So I'm not on that side of our business. I'll just talk anecdotally, and maybe the other guys have a little more detail on it. But the way I usually address this kind of question is not really. But we're chasing, again, relatively high quality companies and still getting good leverage on cash flow type loans. The types of debt has changed a little bit. It's gone a little more unitranche, and the sources of the debt have changed a little bit. Maybe a year to 2 years ago, we could go out and almost everybody would support, relatively high leverage on the companies relative to the industry that we're looking at. So the way I put it is, yes, we can still get it. We're just getting it probably from fewer sources. There are still some very aggressive alternative sources out there that we can still get leverage on. We don't typically look to take advantage of every last dollar of leverage, so that's one reason why I'm going to let the rest of the panel answer the rest of this, but that's our view.
Yeah, we're the same way as Richie. We're not that aggressive on debt. Having said that, the debt providers have offered similar rates as they have before. So the terms of the debt and the structure is pretty similar. I've seen the same thing with the unitranche that's become more players focusing on that aspect of it. So we haven't seen that much change in the source of debt, a little bit, but surprisingly the terms have been pretty similar as they have been for the past 2 years, which to me, as someone that doesn't like to be aggressive on leverage, is a little bit alarming for the overall economy.
Yeah, I agree with that. The CLO market, collateralized loan market is very hot at the moment, and I think for bigger deals, they may have taken over from the junk bond market to a certain extent. One area that we haven't mentioned may turn out to be hotter next year, I thought it was going to be hot this year, is infrastructure. There's a lot of deals out there, most of them outside the U.S. because we haven't figured out how to do infrastructure in the U.S. But in the third quarter, I saw that the biggest deal was an Australian toll road in the world of private equity. So it's an area that I think next year, especially after the election, they actually may come together in Washington on one thing, and it may be infrastructure. So we may see a lot more activity there, and that's a pretty broad phase. It's utilities, it's clean energy, it's water and sewage, it's transportation. So there's a lot that can be covered in that sector.
Yeah, there's been a lot of talk, but no action.
Yep,
presently.
exactly.
So, Jeff, did you want to hit the debt question, or you?
No, I mean, I don't know if I can add too much on what has been said, other than, while I think terms and conditions have remained relatively consistent, the availability of capital is tremendous. I mean, we've seen it a lot on the unitranche side, and just the number of kind of new participants in the debt market is staggering. And I think that's what, in part, is keeping the leverage multiples high, because you have a lot of new participants out there that are trying to create track records and deploy capital.
So as the geek on the panel, I have a question. So under the tax reform, are any of you considering the interest limitation under the new tax reform? That with all this debt, there's going to be some limitations on the deductibility of the interest? Probably not at this point. I know I get that look.
Something we've specifically addressed at this point.
So yeah, all right. So
We need you to come in and talk to us about it, probably. Corey.
yeah, there you go. There's my entree. All right. Last thing I want to just get to is we had spoken about competition and speed and trying to close the deals, and you'd mentioned some techniques and the pressures that you're getting on the time frames of closing deals. So, Rich, you want to start us off?
Yeah, I mean, it's another part of the process that you have to bring your A game and be aggressive. Speed to close has become one of the key elements to being chosen as the winner. And, a couple years ago, it started with firms lining up no financing contingencies is a way to get the close faster. And you did that with various ways, including lines of credit to fund deals. Now, our experience at least has been that you go through the normal part of the process of getting a SIM and reading it and evaluating it and putting an indication of interest and getting to a meeting, but then it kind of has become this process where there's often a check-in bid after that to see if you're still where you were in your IOI after meeting the team. And then from there, you know who the real players are. And there may be 2 or 3 players that are run to LOI. And by the time you're getting to, so that process might be taking a little bit longer than it used to. And people are spending more money and using more resources, so that when you get to LOI, the speed to close from LOI has gone to light speed now, including, recently someone, putting on the table they closed in 7 days from signing. So that's a true story. And we were at like 21, I think. So we've had to keep lowering our, thresholds for that and getting comfortable with that as part of the environment. And so did that answer your question?
Yeah, you did. So,
Okay.
Jeff?
Yeah, almost every process we're involved in today, there's a tremendous amount of pressure on speed to close from the advisor, and it's just something we're having to get our arms around and kind of think strategically about how to get to that finish line. We just lost out on a transaction that we aggressively bid on a few weeks ago because one of our competitors came in and provided that no financing contingency, just over-equitized the transaction, and it made it relatively uncompetitive for us. So,
2 comments. One is we try to differentiate ourselves a little bit by our post-investment value add. So we have to demonstrate that where we can help them with the right partner in China or with the digital transformation strategy. So that we've had to emphasize a little bit more to compensate for a little bit of the speed of close part of it. And then one of the tools that we're seeing in the marketplace more and more is that we have to take on reps and warranty insurance, which I don't love, but
That was going to be my question.
yeah, it's one of the tools the cards that you can play that helps a little bit.
Most of the businesses on the financial services side, and even some of our other businesses, are relatively heavily regulated, and so that is, as an issue that we've had to fight. And one of the ways we do is we know the regulators and know the industry. But one of the things that's happening is in Washington at the moment of the deregulation phase is making those deals go quicker. And so that means that it's important to be able to act quicker than we have in the past.
So one of the last questions. So how does reps and warranties from the past versus present, using it percentage-wise more this year? And what about earnouts? None of you mentioned earnouts. Is that gone in some of the deals you're doing?
I mean, we still push to have earnouts, but I will tell you that the last, several processes we've been involved with, we were told right up front that that type of structure would not be accepted or competitive within the marketplace. And so, again, I think it's a seller's market, and they have the luxury of being able to entertain, several proposals that don't have those type of contingencies.
Harvey?
Yeah, and the two that we did this year, the seller would not accept an earnout. So thinking about in the current one that we're doing, there is an earnout, but it's not a traditional earnout. So I would say half of it is a traditional earnout, the other half is actually an upside incentive beyond what we were already paying. So it's a little bit different than.
The last deal we did have an earnout, but earnout went to the management team, not to us, the seller. So we got our money out, and the management team was the one that had to, and they had enough ownership in the company that it effectively meant that they were going to work another 5 years to really get their money.
Yeah, I mean, we historically haven't really used earnouts, and we try to keep our structures very simple. So that change hasn't. Maybe it's just made it more competitive to us now because more people are doing the structure that we've always done. Nice, simple, pay more and less earnout up front.
So I'm going to turn to the audience. Is anybody? I'm going to take 2 questions if anybody has any. So it's all the
Back
way.
there.
We got a long walk.
Will the Opportunity Zone legislation drive any meaningful interest in manufacturing and operating? Will the new tax legislation for Opportunity Zones drive any meaningful investment in manufacturing or other operating businesses, or will it just be a real estate play?
I don't think. I'm just going to say that right now we've been looking at it and it's not clear. But the question is to them more so, do they think there's opportunity? So
We're going to keep an eye on it. I don't think we have a clear opinion on it. I know I don't personally. It should, I would think, but whether or not it really materializes, I think remains to be seen.
And the other wild card is tariffs at this point for many of those industries. If they're using steel or aluminum as a raw product, that's going to raise their costs. On the other hand, maybe, as the president hopes, will increase manufacturing in the U.S., but again, it's early days to tell.
Yeah.
anybody else want to weigh in?
One of the companies that we're targeting, they're moving their manufacturing. And so the Opportunity Zones is a consideration for them as to where they're going to place their manufacturing.
Great. All right, no other questions? Let's thank our panelists. They were fabulous. On to the next one. Thank you all.